Welcome to this explainer. Look, today we are doing something pretty exciting. We're actually decoding the exact logic behind investor Jeremy Lefebvre's record-breaking $4.6 million stock portfolio. We are going to break down some of the absolute top market predictions right now and reveal how these massive sweeping macroeconomic trends directly dictate high-stakes individual stock picks.
Here's our roadmap for today. 1. The broad market outlook. 2. The AI's semiconductor cycle. 3. Navigating distressed stocks. 4. The hunt for catalysts. And finally, number 5, the $4.6 million strategy.
All right, let's dive right into Section 1, the broad market outlook, navigating the heights.
8,000. Just pause and think about that number for a second. That is the renowned analyst Tom Lee's incredibly aggressive year-end target for the S&P 500. It is a huge call. Hitting 8,000 would represent an absolute monster run for the market, driven in large part by this overwhelming AI narrative and just really robust economic activity. But, as you might guess, the path to 8,000 isn't expected to just be a straight, smooth line up. In fact, a bit of turbulence is baked right into his forecast.
Because look, market cycles rarely ever move in a straight line, right? Lee's prediction actually breaks down into 3 distinct phases. Step 1 is a rally up to about 7,700. Step 2 is a totally normal, healthy 10 to 15% drawdown a little later in the summer as long-term holders inevitably take some profits. Once we consolidate from that, Step 3 is the final rally pushing above that historic 8,000 mark by the end of the year.
And here's the thing about that summer correction. It's literally just math. You simply cannot get the S&P 500 to drop 15% without big tech taking a hit, because companies like Nvidia, Apple, and Meta heavily dictate the entire index's weight. If the broader market drops, well, the Magnificent Seven are coming right down with it.
Moving on to Section 2, the AI semiconductor cycle, euphoria versus reality.
So, as a quick refresher, a cyclical industry is one that experiences massive, explosive expansions followed by pretty dramatic contractions. Semiconductors have historically been the ultimate poster child for this boom and bust cycle. Typically, you build up a massive amount of supply ahead of demand, prices crash, and stocks completely plummet. But right now, there is a fierce debate going on down on Wall Street over whether this current AI-driven semiconductor boom has somehow magically escaped that historical pattern.
And man, this is where it gets interesting. The bull case argues that companies like Micron locking in 5-year contracts proves the cycle is dead. But realistically, locking in massive, long-term contracts actually means they are terrified of downside pricing. They're just hedging their bets. On the bear case side, we are seeing some scary historical parallels to the old oil and gas capacity frenzies. For example, memory giant SK Hynix is currently rushing to list in the US, and South Korea's entire market is incredibly top-heavy with chip makers right now. High demand today absolutely does not guarantee high margins tomorrow once a flood of new supply hits the market.
Let's shift gears to Section 3, navigating distressed stocks, catching falling knives.
Okay, so recently, IBM stocks suffered a highly unusual, brutal 26% drop, which naturally sent investors holding pure software stocks like Palantir or ServiceNow into a total panic. But context is absolutely everything here. IBM's weakness was highly isolated to its infrastructure division, which was down about 7%. An isolated hardware struggle does not mean the fundamental business models of pure software companies are suddenly broken. Honestly, IBM might actually be fairly priced right now, but it definitely shouldn't cause widespread panic across the broader tech sector.
And then you've got Lucid Motors. This is a classic case of an incredibly impressive product paired with basically non-existent marketing. They build a genuinely incredible electric vehicle, but let's be real, in the car business, if nobody knows who you are, a great product just isn't enough to survive. Without serious brand building, their most logical next steps at this point are either a buyout or bankruptcy.
Which brings us to Section 4, the hunt for catalysts. What moves the needle next? So what actually sparks the next massive chip run? Right now, it feels like tech is stuck in this sideways holding pattern, just digesting its recent massive gains. A lot of the good news for Nvidia and memory chips is already fully priced in. To break out of this, the sector desperately needs fresh fuel. Well, all eyes are locked onto one major catalyst right now, AMD. But here's the catch. A slight earnings beat is not going to cut it. If they just barely edge past Wall Street's expectations, the whole sector will likely just fade. AMD needs to deliver absolute shock and awe guidance. We're talking a massive earnings beat and an incredibly aggressive future outlook. That kind of event will act almost like a gravitational pull, dragging the entire semiconductor sector significantly higher.
All right, the grand finale, Section 5. The $4.6 million strategy. High-stakes decisions.
Let's play a little game. If you were absolutely forced to eliminate one stock from Jeremy's $4.6 million portfolio, who gets the axe? The main candidates are Google and PayPal. Now, Google isn't a bad company at all, it's just portfolio overkill if you already own heavyweights like Meta and Amazon. PayPal, on the other hand, is your classic value trap. Sure, it's dirt cheap, trading at a forward PE of just 9, but it completely lacks any real catalyst to draw major investors back in.
Now, what if we're talking about a short-term, end-of-the-year, all-in momentum play? You've got AMD on one side versus ELF Beauty on the other. As we just discussed, AMD has the cleanest setup for a massive shock-and-awe tech run. ELF, however, plays a totally different game. They are masters of the classic low ball and beat. They intentionally set conservative guidance, systemically crush those expectations quarter after quarter, and ride that momentum wave higher. It goes to show that different sectors require entirely different tactical setups. But what if we zoom way out to a 5-year timeline? If you had to lock in a single stock, it really becomes a heavyweight clash between Amazon and Meta. Amazon is arguably the ultimate safe bet. Their AWS and retail moats offer incredible structural security over half a decade. But Meta offers the absolute maximum upside. With their aggressive AI integration and just ridiculously massive user base, their growth potential over 5 years is staggering.
So as we wrap up this explainer, I want to turn this strategic framework completely over to you. Between Meta's explosive high-growth upside and Amazon's structural sleep-at-night safety, which mega-cap giant would you actually trust with your own portfolio for the next 5 years? It's time to weigh your risk tolerance, find your catalysts, and apply this macro view to your very own micro decisions. Thank you so much for joining me today. Now go analyze your next move.